Yeah, I think probably we can start now. So, good morning, everyone. Welcome to the episode 2 of the Survey Science Online Forum. My name is Yuqian Xu, and I'm Associate Professor at UNC Chapel Hill. I'm glad to co-host this episode with Professor Philip Zhang from CUHK. And our invited speaker today is Professor Agostino Capponi from Columbia University. So just a brief introduction for the speaker before we start. Professor Agostino is a professor at the Industry Engineering and Operations Research at Columbia University, where he is also the director of the Center for Digital Finance and Technologies and a member of the Data Science Institute. His research interests are in the market microstructure, financial technology, economic networks, and machine learning in finance. His work has been published in various leading journals, such as the Review of Financial Studies, Journal of Financial Economics, Management Science, and Operations Research. He has also been recognized with Best Paper Awards in different places, such as like FinTech conferences and Informs conferences. He is a recipient of many different outstanding awards, including the NSF Career Award and also the Presidential Early Career Award for Scientists and Engineers. Is among many other different awards. It's just so long the list, so we don't have time to finish everything in detail. But he is also currently serving as the department editor of management science and area editor of operations research. So without any further ado, let's welcome Professor Agostino here, and I will stop sharing here and let you share, Agostino.
Perfect. Thank you so much. Again, I think you really, thanks for the great introduction, and thanks also for shortening the bios so well. So I should get your slide, I think, for future presentations. Let me now share the screen. Let's see if everybody see the slides?
Yes.
Okay, let me do full screen mode. Still good?
Yes, good.
Okay, perfect. Okay, so I will go ahead and I think you should feel free to interrupt me at any time during this presentation. The focus is more like in finance. I understand that for the online service society is of course broader than that, but I hope like what I'm going to say also shows like potential implications and interesting research question which go beyond just the finance component. And let me first, say what is going to be the outline of this talk. I will first start with how we typically think about financial services in terms of some intermediary who is essentially acting as the middleman between buyers and sellers, or borrowers and lenders, or different financial counterparties which want to engage in a transaction. Then I will discuss, okay, what is the disruption that is currently going on in the context of financial services, how we are migrating from cash-based or brick and mortar type of banking to like digitalization and smart contracts. And then I will discuss what are the promises, risks, and the challenges, especially when it comes down to decentralized finance, which is what you might have heard already as a buzzword, which is becoming more and more prominent, and we're still understanding what are the pros and cons. So let me start discussing traditional financial intermediation. If we think about services, we are all familiar with like payments, for example, or retirement plan, or like exchange. For example, if we have to make a payment nowadays, at least in the last few years, most prominent services have been offered by this company, Visa and MasterCard, right, that are specialized in this business. If we think about insurance, then we think about, for example, companies such as State Farm, where you go and you can buy insurance protection against different accidents or sources of risk. If we think about banking, if you want to, let's say, get a mortgage to buy a house, you go to a bank. It could be Chase, could be HSBC, and there is, of course, other services such as retirement plan offered by Vanguard. So all these different companies specialize in a specific area of the financial ecosystem, and of course, they improve and they make our life better because they offer like services that, of course, were not available like many years ago. Now the question is, what is wrong with the system, right? It's not, there is nothing wrong, like it works well, but of course the question is always, can we improve it? Can we get it better? And what are the challenges that we are facing at the moment? And if we think about the traditional financial services, there are, of course, concerns because sometimes it could be costly and slow, like cost of providing capital is typically large, especially for users who do not have a good credit history. If you go to a bank today and you want to get a mortgage and you have a very you have no history, like in a state, for example, in the United States, then you will probably charge a lot of interest rate, right? And even if we want to transact with credit card, there are so many middle layers, right? If you want to make a cross-border transactions, you have to pay several transaction fees, one to your local bank, another to your corresponding bank, and so on. And sometimes it's also slow, the transfer of funds is slow. So there is also a lot of opacity. For example, like it's very difficult to understand, for example, from a financial institute, from financial stability point of view, for example, even for regulators to understand what type of positions the banks have, also what they are doing with users' money. Like once you deposit your funds to the bank, you don't know what the bank is doing, right? They are typically lending this to other companies, but who knows whether they're taking excessive risk or more than what they have promised you. I mean, it's also true that there is very low accessibility to financial services. If you think about the fraction of the populations in the world, which is currently unbanked, it's significant. I think over like $2 billion, 2 billion of people are currently unbanked in the entire world, right? So that means that we are lucky because we have access to financial services. But even if you look at the US population, a significant percentage doesn't have access to banking services, right? So that's like really a question of can we improve, can we make financial access more democratic? And also, there is a problem of interoperability, which also is linked to operational risk and cyber risk, which has to do with the fact that most financial services are highly interconnected. For example, if you have to make a payment, typically this payment might incur several different layers of interactions in the financial network of payments. And of course, if something breaks at one point, it will propagate and it will cause delays in others. So all these are questions that have led to the introduction of like so-called fintech companies and later on to decentralized finance. So what is a fintech company is basically what we are used to, but now using technology. So using technologies basically means hardware system, software system, AI, right? Anything that is essentially elevating from the traditional, more like unautomated service industry. And the pros is, of course, that we get quicker access to these services. Sometimes it's cheaper and it's also more convenient. And I mean, if you think about, for example, in the context of payments, like with Venmo, I think I'm using Venmo. I'm sure that many of you are also using Venmo to make payments. These payments happen to be quite fast because, again, if you make a transaction, typically this is settled. I mean, the transfer of funds happen definitely within a time frame which is higher than if you than if you instead do it through a bank. If you want to do peer-to-peer lending, for example, like it used to be, Lending Club is one of these platforms that provides access to borrowing and lending services. So instead of exactly as I mentioned before, going to a bank, now the lenders will deposit to a lending platform, and then this lending platform, which is, for example, Lending Club, will take care of distributing these funds to potential borrowers. And I mean, even if borrowers have a limited credit history, they will still be able to afford lending. So this was one way of trying to democratize access to borrowing and lending services. And we have also other companies like Square, which is another like service provider, which is very important for the provision of credit. And there is Betterment, which is one of the most prominent financial robot advising firms. So they are all like trying to automate access to financial services to make it faster and quicker. Of course, all these companies are always relying. I mean, what are the cons? If we want to identify some cons, we have to say that this type of fintech services are built on the traditional financial infrastructure. So, for example, like if we think about Venmo, it's still linked to your debit card, right? So it's still relying on the traditional financial system. Again, there is not. I mean, the access is not always very transparent. And there are like social costs involved with the services because, for example, Robinhood, which is a major brokerage service firms, typically they try to monetize on this data. For example, they sell this data to high-frequency trading firms, and of course, this creates some potential moral hazard question, right? So it's not really all great, but definitely we had some improvements. So let me focus on one of the main financial services that have emerged, especially after the financial crisis, which is the so-called financial robot advising. basically the idea is that if you want to get financial advice, or if you have monies to invest, mostly I think to meet some of your goals. For example, you want to make sure that you have enough money 5 years from now because you have to buy a house, and 10 years from now because you have to pay for some schools, and maybe 15 years from now because you are thinking about making a major renovation. So what you do is you have some goals, you go to a company and you say, okay, here is the money. For example, like every month I will give you a fraction of my paycheck will come to you, and try to invest it in order to meet these goals. I will specify what are my goals, what are my risk preferences, what are my characteristics, and then the algorithm will take care of investing on my behalf in order to meet these goals and these constraints. So what are the pros? The pros is that this algorithmic advising could be tailored, could be specified to offer personalized advice. So it means that, for example, if Yukian comes to the robot advising firm, and she's like very risk averse, maybe she specifies these preferences. Okay, here are my goals, but I also want to make sure that I don't fall short on those goals with very high probability. But maybe Philip comes and say, for me, it's okay if you try to meet these goals, and some of these goals have higher priority than others. So try to invest in a way that the higher priority goals are more satisfied than the lower priority goals. So everybody can basically specify their own preferences. And then the algorithm, because it's an algorithm, right? You can input these preferences, and the algorithm can operate in order to meet these preferences and goals. And typically, these algorithms are fairly sophisticated because they can be they can be specialized and personalized to meet specific requests and specific constraints. At the moment, they are being used mostly for rebalancing portfolios, so to decide basically how much to change the portfolio from one month to the next, how to manage taxes, right? That's another constraint. And they have very low entry barriers. So if you compare these these robot advisors with the traditional human advisor, right? That was the case before this computer algorithms came into place. Typically, for financial robot advising, if you go, let's say, to Betterment, for example, you can go and pay a fee for your asset under management, which is extremely low, right? Say the fee is on the order of 0.1%, and this is like one order of magnitude smaller than if you go to a human advisor, which will charge you at least 1 or 2% of the entire asset under management. So you have a significant saving fee. Why? Because this is an algorithm, right? It can serve multiple clients simultaneously, right? It doesn't have to be serving one client at a time. Whereas if you go to a human advisor, he will have to have a call with you. And of course, he cannot serve like thousands of people, right? Because he doesn't have thousands of hours at disposal during the day. So that's basically one of the main significant advantages. But of course, the cons is that these algorithms are not always transparent, because there has not been a lot of auditing yet provided. So we don't know if, for example, some of these algorithms are biased. Maybe they are biased by the designer of the algorithm, because of course they have some views and they want to incorporate these views into the algorithm. There has been very limited testing, and we haven't really experienced any significant like crisis that could have been used to determine whether or not this advice is being offered as it should. And of course, there are a lot of operational risks, cyber risk, and systemic risk involved, because of, one thing is that these robot advisors have a lot of data, right? Because they have all the personal finances data from individual customers, and therefore, like if somebody accesses this data and steals them, they will have access to all the strategies and investment and demographics, or even confidential information from many different users, right? And this is of course a question, like, they have to be designed in a way that they are very safe against potential attacks, because they manage a lot of money, right? They are increasingly, the asset under management has been increasing steadily since the last COVID crisis. And I think in a paper, we have looked at how can we design algorithms to improve personalization. So how can we actually try to personalize the advice to meet client preferences, risk preferences. So I focus on a very narrow aspect of personalization, which is risk preferences. So you tell me like your risk preference, and for me, risk preference was specified in terms of some risk aversion parameter, and then I will invest so that I will make you happy. Like if you are more risk averse, then I will take a safer strategy. If you are less risk averse, I will take a riskier strategy. And I will make sure that if you adapt your preferences over time, because, for example, you are sensitive to the economy, you are sensitive to idiosyncratic events that happen. For example, one may lose a job or may change profession. So many things can happen. You change your risk preference, your risk profile, and the algorithmic robot advising is adapting to these changing risk preferences. So that's a very, very small aspect. I think there is a lot of interesting research to do in terms of personalization with respect to other criteria, right? Doesn't have to be just risk preference. It could be what are your goals. It could be personalized to your specific demographics, or many, many other. Yeah. And what you see on the right is basically a study. We did a counterfactual study about what would be your rate of return on investment if you go on your own, which is the client, and what would be your return rate of investment if you go to a robo-advisor. And as you see, the distribution, the PDF is shifted towards rise, which means that basically we can show that robo-advisor is offering a larger rate of return compared to the client. Okay, so that's basically one aspect of fintech. The other new emerging aspect of fintech that I've also been working on, and that which I think has a lot of promises, is the fintech that is built on a blockchain. So this is, I think, a topic that is also emerging more and more in finance, but also in many other contexts. Like it could be used, for example, to manage like risk in supply chain, and in many other like production networks, in many other like infrastructures that typically rely on centralized authorities. So let me give you just a brief overview of what blockchain is. It's essentially a decentralized database or ledger, which is shared among many different nodes of a network. So the basic idea is that there will be nodes, there will be in this network, and they will transact. And the idea is that, for example, if I want to borrow or lend, then I will have to go to a smart contract, which is essentially offering this service. If I want again, but how does it all work? So the smart contract will basically be responsible for taking all these loans that will be provided by lenders. It will determine a price of these loans, at what interest rate you will be able to borrow, and then it will give you an agreement and say if you borrow, you will have to pay this interest rate. And this smart contracts are essentially computer algorithms which are running on a blockchain. They are self-executing. They are state-dependent in the sense that when the state of the system changes, they will execute. For example, if you give me this amount of funds, then depending on how many other funds I have available, I will determine the interest rate. So if the state of the system changes, then the output will also change. And they are essentially able to enforce agreement based on pre-specified conditions. So they are like really enforced commitment, because you cannot change your mind, right? Once the smart contract has decided what are the terms of the deal, then they will have to be respected. And it doesn't matter if you are providing a lending and borrowing services, an insurance, an exchange, right? Asset management, they are all basically interacting with the smart contract. So the smart contract essentially decentralizes the entire system, because you no longer interact with a single intermediate, but you interact with this computer program, which is responsible for provision of service. So let me now make a comparison just to fix idea. I think we probably, some of us are familiar with exchange. So for example, like in the US, the New York Stock Exchange is essentially a marketplace where everybody wants to buy or sell stocks will go, right? Typically, we don't go there directly. If I want to buy an IBM stock, I don't go directly to the exchange, but typically I interact with a broker, which will do it on my behalf. And the idea is that, these exchanges are essentially marketplaces which have a lot of liquidity, which providing all these shares that will be purchased or sold by buyers and sellers. These are the so-called market makers. So these market makers provide all this liquidity to the exchange. And then if I want to buy a stock, I go to my broker. I will have to pay, of course, a broker fee. The broker will go to the exchange and will say, okay, I want to buy this share on behalf of Agostino. And then they will have to find this share, and this share will come from, again, the market maker. Similarly, if the seller wants to sell, they will not be able to sell directly a stock of IBM. They will have to go to the broker, and the broker will sell the stock to the exchange. So that's basically how everything works. Everything has to be intermediated, right? There is an intermediary, which in this case turns out to be the exchange, which makes sure that buyers are matched with sellers. Now, what happens when we think about decentralized finance, which again is running on the underlying blockchain, is that we replace the exchange with a smart contract. So we no longer have an exchange in this infrastructure, but we have an algorithm, right? The smart contract, as I mentioned, is a computer algorithm. And this algorithm is interacting with, is in the interface to all potential buyer and sellers. So if I want to buy or sell, I don't have to go to the broker. I just run the smart contract algorithm. So I make a request to the smart contract saying, I want to buy these stocks. And the smart contract will say, okay, you can do that, but this will be the price, right? Because the price will depend on the state of the system. And the smart contract is able to adaptively change the price based on how much liquidity there is. So liquidity providers are basically replacing the market makers. They are providing liquidity to the smart contract. The smart contract is building an inventory, and then they are determining the price of these assets based on the state of the inventory. And in order to get some information from what is happening outside, there will be the so-called price oracle. These oracles are basically feeding information to the smart contract because the smart contract doesn't see anything except for what is provided to it by liquidity providers. Right? So that's basically a very important difference because we cut some layers. You see, I no longer have to do buyer, broker, exchange, broker, seller. Just the buyers interact with smart contract, seller interacts with the smart contract. So, and this interaction is fairly simple. I just have to basically run an API that basically makes a request to the smart contract, and the smart contract will give me what I want. So that's basically, I mean, it's super simple in terms of disintermediation. That's why sometimes you hear that this is disintermediating, because we no longer have the need of an intermediary, right? The exchange in this case, it's just a smart contract. So the idea is that these marketplaces are actually being more and more popular, especially the one deployed on this decentralized infrastructure, because even assets that you were thinking were very, very illiquid, like art, music, like it's really difficult to see a lot of transactions for art or music, right? Typically, you have auction houses, but perhaps these auction houses are basically responsible for, purchase or sales of art pieces, but you don't see really many transactions done, right? You see maybe one transaction every couple of days or so on. But with non-fungible tokens are essentially, fungible assets are essentially a way of digitalizing illiquid assets such as art or music. So the idea is that instead of transacting a piece of art, you digitalize this piece of art, you create a token, which essentially would represent this art on an underlying blockchain, and then you allow participants to exchange these tokens. So exchanging a digital tokens is definitely easier than going to an auction house and performing a transaction. And the advantage, of course, is that we have higher price discovery, because now there will be more transactions compared to illiquid assets, illiquid primary assets. So you can think of this as like a digital form of asset, which has more liquidity because it will be easier to transact this token. And there will be, of course, more transparency because you can observe these transactions, right? Unlike maybe auction houses where you only see you cannot observe all transactions that are happening. You only observe the one that you are involved. Here, like everything is very transparent, so everybody can see like the entire set of transactions. So that's again an advantage of this digitalization, that you basically by bringing these assets so-called on chain, you increase the liquidity and therefore you make things easier to analyze. Now, another important component is governance. Like when we think about publicly trading company, right? For example, those whose shares is transacting on the New York Stock Exchange or on the Nasdaq, typically the governance, which means the decisions on, let's say, whether or not we should increase or decrease the amount of capital allocated to specific business lines. This is done through voting by shareholders. So the shareholders will have the right to vote depending on how many shares they hold in the company. And there are a lot of problems that are present in this governance. For example, there is the empty voting. So some shareholders might try to game the system. They might borrow shares just temporarily so that they hold these shares and therefore they can vote. And then after voting, they sell these shares, right? This is the so-called empty voting. There is also overvoting, which means that some shareholders might vote twice, for example, because they can take advantage of some glitch or some operational inefficiency that are in the system. Because as you can see from the diagram on the right hand side, it's a very complex system, like when you vote, and therefore if something breaks in one of these flows of transactions, then there will be a possibility to game the system. So that's basically what we see now. If we think about the blockchain, the governance is simplified because everything is replaced with decentralized autonomous organizations. So these decentralized autonomous organizations are essentially a way of creating marketplaces on a blockchain. So the way it works is fairly simple. So the idea is that if I want to fund a project, what do I do? So if I want to fund a project, what I can do is I can create a so-called DAO, and I essentially say, okay, I'm requesting for funding of this project. And then all the investors who like my project will be able to give funding. And as a compensation for offering this funding for my project, I will offer some so-called governance tokens. So tokens which essentially certify that they are participating in my project by funding it. And everything is managed by smart contracts. So again, the smart contract is responsible for collecting funding and offering governance tokens to those who are providing funding for the project. And by doing so, they will be able to participate in voting decisions, right? For example, like if my project evolves, and then the governance token holders, who are those investors funding my project, can say, okay, now we want to see some change to your protocol. Like I want to see, if I was designing, let's say, a protocol for let's say borrowing and lending, I can say, okay, I want you to change the way you determine the interest rate, or we would like to hire a new team of developers, right? Because we need to expand our business line in some direction. And all these decisions will be decided by the governance token holder. So it's essentially a new way of governance, right? You decentralize this governance through offering this governance token to whoever wants to be a participant in this project. And the nice thing is that everything about the governance decisions will be very visible and transparent. So if there is a new proposal to make a change, for example, to the system, a governance token holders can basically issue this proposal, and then there will be voting, and you can see not just voting in the sense, okay, I vote in support, I vote against. You can see really the discussions going on. So for example, if people have very strong views in changing the protocol, they will express these views, and the intensity of their views will be definitely overcome. Maybe they will be stronger than somebody else who is a little bit more maybe against change to the protocol, but he doesn't have really a strong voice on that. So you can really do voting in a much different and broader way. It's like not just electronic, but real in terms of analyzing all this and all this language, all these discussions that we see on the board, and coming up with a decision, right? And this DAO, by the way, is like I mean, it's becoming more and more prominent. I even know that a couple of weeks ago there was a company which wanted to provide some funding, crypto funding to Colombia. And but they wanted to do it through a DAO. And the idea is that if you do it through a decentralized organization, then you have something to say, right? You give funding, and then you can discuss, you can participate in how this funding is allocated. Like again, you can micromanage some of the project. You can say, okay, I want this funding to be more allocated towards research in, I don't know, in it'd be cyber risk versus research in let's say supply chain, for instance. So it's really a new form of, right? And you can see, again, as I mentioned before, I mean, this is, I think, an interesting area that has not been explored. I always thought that this, I mean, I think it's a very nice area of research, despite the fact that it's very relatively new, and it's basically governance discovery. So in finance, market microstructure, many people have looked at price discovery, right? There is always about, okay, how much information is incorporated into prices. So how much can we learn about prices of companies, prices of shares based on trades that we see happening in the limit order books. But here we can do a lot of governance discovery, right? Because the governance proposals, typically these are just text discussion that you can really, I mean, if you go on Google and you say DAO governance of, let's say, Uniswap, which is the major decentralized exchange, you will see all the proposals that have been made to change something in Uniswap. It could be changed to the smart contract protocol, which determines prices. It could be changed to the interface. Maybe we want to change the interface. We want to add new features to the interface, or we want to change something that we have in the corporate governance, or how we allocate the governance tokens, right? These are all proposals. And then you can see people who are voting, and you see the discussion. Somebody writes, yeah, I think this is a great idea, or no, I don't think so, we should do something different, and so on. So anybody who owns this governance token can vote, right? If I could also be a governance token holder if I support Uniswap. Of course, if I don't have a large share of governance tokens, my vote will not carry a large weight compared to others who hold more governance tokens. So the more governance token, the higher is your stake. And but still, you can see, like, you can basically, by analyzing these discussions, you can understand a lot about the direction that the company is taking, right? You can really learn about. And I mean, how to do that? I think this is an area, I think it's a very interesting area where you have to do really, you have to use some like NLP or new machine learning tools, right? Because it's really analyzing text, analyzing discussions, I mean, and try to understand what directions the company is taking. So as I mentioned, like, this is a very interesting, essentially, it's really more about, I mean, the question is, okay, price discovery is when we look at just trades and how buyers are interacting with seller. But here we can say, okay, how much disagreement there is between holders of governance token. This is really what tells us about governance discovery. So if they are disagreeing a lot, it means that maybe there is something to be learned in terms of how they want to run the structure. If they're all agreeing, perhaps it means that what they are currently doing is already good. And I mean, if one could collect data on this consensus, and this data is all publicly available, I think this would be a great area, in my view, for research. So now let me discuss what are the advantages of the fintech built on blockchain. So the idea is that, again, why do we still want to use this infrastructure? Because we can reduce intermediation cost. We can really make sure that we don't have so many layers of intermediation across the chain. We can have faster settlement. So settlement is very fast in the sense that I don't have to wait too long to complete, let's say, a cross-border transaction. You can do it easily and more efficiently. You can have much more transparency because the current design makes data and anything else publicly available. There is accessibility. It's easier to access because, as I showed earlier, you just read an API that connects to a smart contract. So it's really, and I mean, the cost of accessing, I mean, you just need some slight education in technology. It's not that much, and you will be able to directly transact and interact with these smart contracts. There is a new mechanism of accessing, providing liquidity, which is crowdsourcing. We are no longer competing in terms of, okay, I provide some liquidity, you provide some liquidity, and I want to make sure that I can get better prices for my execution because we would be sharing the risk. So the mechanism changed from competing to more risk sharing. And of course, there are also advantages in terms of interoperability. So the interoperability and the risk of operational risk is somewhat changed. I mean, it's supposed to be smaller if you design the smart contract better, but this still remains to be seen. This is another area that is currently being under discussion. So in terms of intermediation costs, I just want to give you an overview. If you think about the large commercial bank in the United States, they make most of the revenue from charging fees, right? This is how they make money. So, for example, like JP Morgan Chase, they collect, just in 2020, they collected $129.5 billion in just fees. They charge, like, increasingly, they charge an impressive, large amount of fees. And this is all like revenue that is being generated and taken away from us, right? From depositor, from like ordinary people who are interacting with these banks in order to get access to financial services. If you think about the decentralized finance protocol, again, the smart contract that implement different services, here I've listed the exchange. So Uniswap is the largest smart contract that implements a decentralized exchange, which means collects assets and makes sure that if you want to swap one asset, if you want to swap, let's say, US dollar for euro, you will be able to go and make this exchange transaction directly with the protocol. I also listed some other protocols. For example, Aave is a borrowing and lending protocol, which means that the smart contract will take care of collecting funds from lenders, and it will make sure that these funds collected from the lenders are priced and offered to borrowers in terms of an interest rate, and make sure that there is always some degree of utilization in the pool, in the sense that if there are smaller funds, the interest rate will adjust because there is more limited supply. If there is a lot of funds, then the interest rate will go down. So this is basically, these are all smart contracts. And if you see the fees that the contract is charging, so I've decomposed this diagram into two. I mean, each bar has been broken up into two pieces. The revenue that goes to the protocol, to smart contract protocol, and the revenue that instead goes to the pool in a way, right? That is not really appropriated by the protocol itself, but it's like still there in the platform. And as you can see, the revenue that is taken by the protocol is very small, right? So these protocols, they are not really extracting a lot of revenue from the users. Like Uniswap, for example, is not charging anything for using the protocol. Like Aave is charging a little bit. This other exchange are, definitely the largest percentage of the fees that are paid by those users, the trading fee that is paid by the users who are transacting is basically being added to the pool. Therefore, who are benefiting are those who are providing liquidity to the pool. Of course, you might argue, okay, this is the case because maybe these protocols are still new, so you want to attract more participation, more users. Later on, perhaps the protocol will charge more, but still, the idea is that the fees are not really large. So this, in a way, protocols are not extracting a lot of rent, as sometimes it's said in finance, but rather they are trying to democratize this access to financial services, redistributing the fees that are paid by the traders to the market makers. So it's not really taken, the platform is not really trying to get a lot of money away from them. If we think about settlement, that's also, we see also that there are significant advantages, because if you sell a stock on an exchange, right, you might, some of you might have read, but some others were not aware. And in fact, I was not aware when I first started looking in finance, that when you sell a stock, it's really not done instantaneously. It's not that you sell a stock and the stock is already out of your account and deposited on the account of the party that is buying the stock. Rather, what happens is that there will be a settlement delay of at least 2 days. So the idea is that you sell a stock, then the trade is not considered to be finalized until there has been really the so-called settlement, which means that there is an exchange of assets between one end and the other end. So there will be a lot, and the reason why it's not instantaneous is because one is to make sure that you really hold the stock that you are selling, like you are not selling something that you don't own. Then it has to be transferred to the account of the user who is buying the stock, and all this verification process will take 2 days. If you think about settling a transaction on a blockchain, for example, I want to swap one asset for another, this is happening instantaneously. So really, at the moment where your transaction is confirmed for execution, the swap immediately occurs. So there is a transfer of assets from one party to another. So this is, of course, is an advantage, right? It's an efficiency gain in terms of reduced latency for transaction execution. Next step is in terms of transparency, right? So let's think about what happens when we have a transaction executed on a blockchain. So this is basically a snapshot of what you see. You see exactly what type of transaction it is. For example, in this case, there is a transaction which is swap. There is a swap of 235 Alice token for 1.4 token of Ethereum, happening on this smart contract, which is called Uniswap v2. So you can see the entire details of the transaction. You see when this transaction happened. In this case, it happened 9 minutes ago, and it was November 25, 2021, when I took this snapshot. You can see also whether or not this transaction has been successfully executed. It's called success or failure. So if it's successfully executed, that means that this transaction occurred. You can see where it has been added. So all the transactions, once they are executed, they are added to this block, and that's why it's called blockchain, because it's a sequence of blocks linked through each other. And you can also see what type of actions occur. For example, there has been to make this swap, there has been a flow of money from this digital wallet, which is 0xBC, to the digital address of the Uniswap protocol, which is the smart contract which is implementing this transaction, for this amount of dollars. Right? So you can see that there is a lot of and you can see also how much fee you have paid, transaction fee, in order to get this transaction executed. In this case, you pay the transaction fee to get this transaction prioritized, which is on the order of $72.64 or 0.016 Ethereum, which is the currency used to pay for fees. So there is a lot of transparency, right? All this is publicly available, a lot of data. You can see really everything. And this is, of course, a big, big change with respect to a traditional financial infrastructure where I cannot see if Ukraine is making a payment to Philip. I don't know, right? I mean, this is just done. Probably only the bank, which is executing this payment, knows, but nobody else can see it. So here you can see it. So that's a significant. Right? You can also see the code of smart contracts. If you want to say, okay, how does Uniswap, how this smart contract, which is pricing the value of one asset for another asset. These assets are called token when it comes down to blockchain. But if I want to see at what price, let's say the Alice token is being swapped for the Ethereum token, this is determined by this function, right? They look at the balance and they see whether some of these conditions are satisfied, and then they will basically determine, okay, at what price this transaction is executed. The programming language is called Solidity, so one has to be a little bit familiar with this object-oriented language, but then you can really see everything about the code. So these are all open source hard-coded algorithms. So the open source is actually an important feature of this new way of providing infrastructure. So the open source is great because if you can really look at the code and you can say, okay, I like what this smart contract, I like the type of rules that this smart contract has in terms of pricing the token, so I'm going to transact with this smart contract. Or you say, okay, I don't like this smart contract because maybe I don't like this piece of the code, I don't like what type of pricing rule they are determining, so I'm not going to transact with this smart contract. So you can, of course, it requires some level of education because you need to understand what the smart contract is doing. Typically, what the smart contract is doing is summarized in some white paper. Each company which deploys the smart contract summarizes what their algorithm does in a white paper, which is like written in plain English, so understandable by a broader audience. But if you are really a very high-tech person, you can see exactly what is going on. And if you want to deploy your own smart contract because you want to start the new protocol, you can do that, right? It's very easy to access. I mean, for example, I was talking last week, I was in Paris and there was a new startup done by French people who essentially constructed the smart contract for borrowing and lending, and they were able to market it well, and now they are like competing with Aave and Compound. Just if you have an idea on how you should price, then you can implement a smart contract, deploy it, and if a lot of users are starting to use it, then you basically launch a protocol. So it's easy. If you're thinking about startups in DeFi, it's much easier than regular startups. And as I mentioned, like there is a lot of transparency. You can see the prices. You can see for each pool how this utilization rate is a metric of what's the percentage of funds that are being borrowed, like over the one that have been lent. So 18%, it means that 80% of the funds are being borrowed. So the pool is being utilized, right? You don't want a pool where everybody's depositing liquidity and nobody's borrowing. Otherwise, it would be useless. Why would you ever deposit funds to a pool where nobody's lending from? So these are all metrics that you can see. They're published, they're posted. You can see what interest rate is being offered, and I mean, it's a great study. So again, just to summarize, the liquidity is crowdsourced, so you can gain immediate access to liquidity by interacting with these smart contracts. The algorithm is setting the market prices, and again, there is democratization because everybody wants to access liquidity. The barriers to entry are basically zero because you just need to create an account and then you can interact with smart contract. So it's very easy. Now, everything seems great, but of course there are some cons, right? It's not really that this is if there was no cons, I think we wouldn't be talking about it. Everybody would have already migrated except for like maybe some inertia that it takes to migrate from the traditional system to this new system. But I want to highlight some of the current challenge that we are facing. So again, we have settlement speeds, which as I mentioned before, it's faster. But of course, this brings up questions about, okay, what capacity can the system handle and how large are the transaction costs? When there is full transparency, you always think, okay, it's great, because if everybody was honest, maybe like most of all of us are, then we don't have to worry. But of course, there are dishonest people who are trying, or people who are trying to take advantage of all this transparency to exploit it, right? To personally monetize it. And this is like the problem of arbitrage. There are some hidden risks of providing liquidity. Interoperability, like if we have this system, everything is implemented through a smart contract. So as I mentioned before, for example, a smart contract, which is determining the price at which you swap one token for another. And then there is a smart contract, which is determining at what price you would borrow funds from a pool. What could happen is that you can borrow funds from a pool, and then you can swap these funds into another smart contract, which is handling the exchange, right? So there are this essentially means two computer code, which are calling each other. So there is a lot of like interconnectivity, interoperability coming from interactions between codes or smart contract. And this brings up questions about operational risk, right? If I'm able to manipulate one smart contract, so I can force it to do activities that are actually, maybe I can exploit a bug in this smart contract, and I exploit this bug, and then I make sure that, for example, it transfers funds to my personal account by going through another call to a smart contract, which is managing borrowing and lending. This, of course, is not good. And this, I know that Yukian is an expert in operational risk, so I'm not going to discuss more about it. But I just want to mention that there are questions about how you interoperate the systems, because, again, it's a network of smart contracts. It's a network of computer programs. And also, we have governance, as I mentioned before, it's decentralized. So we have governance token holders who can participate in these voting decisions. And this brings questions about incentive misalignment. For example, I might want to get access to many governance tokens, because then I can have more voting power. I can influence the decision of the protocol. And then once I made the change that I wanted, maybe I will sell this governance token. So there is a lot of questions that we have to make sure that we don't create a centralized governance structure, right? It's great that it's decentralized, but of course, can we really support, can we sustain this decentralized governance mechanism? Okay, so let me say that where are these questions coming? Why there are all these costs? Because if we think about the way that this infrastructure works, typically, as I mentioned before, every transaction, once it's executed, is added to a block. And these blocks are constructed by the so-called miners or validators. And what they do is they keep the fees that are paid, the transaction fees that are paid by all the users. So if you want to prioritize your transaction, if you want to make sure that your transaction is executed fast and quickly, then you have to pay a large transaction fee, because then the validator or the miner will add your transaction at the very top of the block. The more you pay for execution, right? If you pay higher, I will put your transaction on top of the block. So that means that because I get to keep all the transaction fees, that's why I'm providing this service of executing your transaction and adding them to the block, because I get compensated in terms of the fees. And of course, this creates some incentive for potential manipulation, because people might bribe the validators to prioritize that transaction. If we think about processing capacity, the current financial system is very good. Like, for example, Visa can handle 24,000 transactions per second. So it's huge, right? They have a huge transaction capacity. I mean capacity. I'm not saying that Visa is operating at capacity, meaning managing 24,000 transactions per second. Visa has a potential of handling 24,000 transactions per second, which is significant, right? It's a lot. Ripple, which is like a modern like fintech company, they can handle 1,500 transactions per second. So Ripple is like one of the companies, fintech company, which is implementing their own decentralized ledger for like payments, right? So they are, you see that even though they are the second largest after Visa, they are still orders of magnitude smaller, right? In terms of how many transactions per second they can handle. And if we think about more popular blockchain, like Ethereum, for example, they can handle 20 transactions per second. Bitcoin can handle 7 transactions. So it's really small. Right now, they are trying to upgrade their system to make sure that there is a better execution, but it's still very, very slow. Now consider like I want to make the point that despite the fact that the more like old style blockchains such as Ethereum can handle only 17 transactions per second, if we think about, for example, companies such as Solana, which is new blockchain which are emerging nowadays, they can handle 49,000 transactions per second. So technology is really getting better, right? They are trying to build systems which are able to manage more and more transactions, because the more transactions you can manage, of course, the better is for users to transact. On the other hand, there are a lot of technological risk problem with Solana, because the fact that they can handle so many transactions per second means that many times the system breaks, and if the system breaks, then you have to restart everything from scratch. So it's not really that this is a very promising approach, but it's not really definitive. There are questions, as I mentioned before, because everything is transparent, there is the so-called problem of front running. So in a way, suppose that I observe a transaction submitted by Yukyuan on a blockchain. So she wants to swap, let's say, euro for dollar, right? You have euros and you want to swap for dollars because you went to Europe and you got some euros. Now, I can see that you want to swap euro for dollar. So what I can do, I can send another transaction where I swap a much larger amount of euro per dollar. So you want to swap, let's say, 100 euro, 1,000 euro per dollar. I say I want to send an order to swap 1 million euro per dollar. And what I'm going to do, I'm going to pay a larger transaction fee so that the validator will add my transaction before you. So that means that after I swap 1,000 euro per dollar, the price of dollar per euro will go up a lot, right? Because it means that there is a lot of demand for dollars. And as a result, when you execute your transaction, you will execute at a much larger price. So I can create a price impact that essentially comes from the fact that I execute the same transaction that you wanted, but at a much larger quantity and at the price that you should have paid. So I raise the price significantly, then you execute at a much larger price, and then I execute the reverse transaction. So I front run and then back run you, which means that I'm basically extracting a lot of revenue from you. So this is unavoidable, right? This is just a consequence of the fact that when you want to submit a transaction, you have to post it publicly, and therefore everybody can view and can act on it, right? There is really no solution. And in a paper, we have looked at this problem, and we have seen that if you look at all blocks that are added to the chain, a very high percentage, over 90% of the blocks contain transactions which can be attacked, which are exposed to different running risk. And actually, of these transactions, these blocks which contain attackable transactions, a significant percentage is indeed attacked. Like, it's not really, it's about 20% of all transactions which are attackable end up being attacked, right? This is like a problem, of course, because it discourages user from using the infrastructure. If I know that I can be front run, I'm not going to send transactions. So this is a disincentive in using this technology. And the revenue, the number of attacks have been, again, generating significant revenue. For example, the revenue is typically between 0 and 0.2 Ethereum, which is about $200 per transaction, right? $400 per transaction. It's not really small. It's still a significant amount of money that is being used. And I mean, we have also looked at like other problems of liquidity provision. For example, the fact that there is probability for an arbitrage. Because when I trade on an exchange, typically the price changes after the trade. The red point is the price of one token A for token B before the trade. And then after the trade, the price has changed, let's say, from 8, 10 to 15. And the price of token B went from 10 to 6.67. So that means that there will be possibility to execute the reverse trade, and therefore making this money at the expense of those who are providing liquidity. So these are all problems that are, of course, inherently done in liquidity provision. So next point that I wanted to make is about protocol risk. So that's basically the idea, is that all these protocols, as I mentioned, these are smart contracts, computer programs that are all interconnected with each other. For example, like you can, again, collect, you lend or you borrow from a collateralized lending platform, and then you use your borrow funds to exchange, and you exchange these funds for another token, and then you convert them into one of the major cryptocurrencies, right? these are all like linkage which shows the interconnectivity of these financial services. For example, like if we think about DAI, which is one of the major stablecoin, these are essentially maintaining their value by ensuring that for each token that is minted or constructed, there is an amount of collateral reserve that is posted on Ethereum. So this creates a link between lending and minting of cryptocurrencies. Okay, good. So finally, I want to make the point about decentralized governance. I already mentioned that governance is transparent, it's decentralized. Everybody wants to fund a startup, which is called a decentralized autonomous organization, can participate, can provide funding, and get governance tokens. But then there is a lot of misalignment of incentives because the governance token holders, those who have participation in the decision of companies, they might have different incentives. For example, some of the governance token holders might just want to extract very high interest. They want to make the interest rate as large as possible, perhaps because they have deposited funds, right? They want to deposit funds and therefore they want the interest rate to be large so that they can make a lot of money. Maybe other users are also governance token holders, but they are more interested in borrowing. So in their case, they want to get cheap funds, so they want the interest rate to be low. So they will disagree in terms of, okay, how should the protocol determine the interest rate? If I'm using this protocol mostly to borrow, I want to have low interest rate. If I'm a governance token holder, so I funded this project, but I'm mainly interested in lending, then I want high interest rate. Then there could be some speculators, those who are perhaps not really interested too much into the project, but they're just interested in pumping the price of this governance token up, right? These governance tokens can also be traded. So the fact that you have, that's a very important difference with respect to the traditional system. Like if you have voting power in a company, like this is just depending on your share of the stake in the company. But if you hold a governance token, which gives you the right to vote, you can also trade this governance token. You can go to another exchange and swap this governance token for others. So if you are like a speculator, you want to pump up this governance price token because you want to execute transaction at a larger price. So attackers, people who are like looking at vulnerability of smart contract, operational risk, they want to manipulate this protocol so that they can extract as large profit as possible. So you can see that there are a lot of misaligned incentives. And actually at the moment, if you look at who is really governing this platform, it's really very centralized, right? Because you see that the top 100 token holders, like in one of the main protocols, which is called Maker, you see that the top 3 already hold more than 50% of all the governance tokens. So this blue is basically one holder of the governance token, and these are typically called big whales in the sense that these are the ones who really determine what is going to happen with the protocol. So we want the decentralized governance structure, but then you see that at the moment, all these incentives are pointing towards a very centralized governance structure. There are questions about, okay, there has been a lot of discussions, especially right now, what type of risk should the regulator address? Okay, we should try to remove scam and manipulation, right? Because this smart contract can be manipulated. We have to be careful that these technologies are not being used to recycle money, right? Because taking advantage of this the fact that every transaction is anonymous, of course, it could give rise to incentives such as money laundering. And also, like many regulators are worried about how can we ensure that all these DeFi or these smart contracts are interoperable and interconnected, that we can exchange tokens by leveraging the different application layers. And there are a lot of barriers that are currently being faced. First of all, these technologies are decentralized, not just within a country, but they are decentralized worldwide, right? Because they can be accessed for any country. They are anonymous. Like if I transact with a smart contract, I create my digital address, and nobody knows who is behind the digital address. You only observe the code, the ID, but you don't know who is behind it. And of course, you need also to be well-educated in technology because, traditionally regulators are mostly lawyers, like people who have a background in law or economics. But if you want to regulate this smart contracts, you need to understand how do you regulate a piece of code, right? Because the smart contract, after all, is a piece of code. So you have to make sure that, for example, there is some documentation in terms of verification that the smart contract is indeed operating as is described in the white paper, right? It's not really doing anything suspicious. And of course, to do that, you need to be educated to the technology. But at the moment, there are still ongoing discussion about the legal framework. How can we set up a legal framework to regulate these technologies? And there is always a trade-off, because if you impose tighter regulation, if you regulate the system more and more, then you will reduce financial innovation, right? The more you regulate, the more the less innovation you have. There is also, of course, if you want to regulate more accurately, this will be slower because you need to take more precautions. And I think if you don't want to slow down a system which is very efficient just because of regulation. Otherwise, we are back to the original system, right? If you now we can do a cross-border transaction very fast, but if you say, okay, now we have to stop you when you go from one jurisdiction to the other, that means that you are, again, back to the original system. So we have to understand how we can regulate this technology without losing the benefits and the advantage that we have, let's say transparency, speed, efficiency. I think we also need to think about risk measures, right? If we think about risk, I don't think we can think about measures of risk, operational or cyber, in the traditional way, right? Because now we are thinking about risk, which is again linked to the interoperability of these smart contracts, and risk which is really linked to the fact that we have a decentralized infrastructure. So what will be the new measures of risk that we have to design in order to understand these protocols? And that's pretty much what I wanted to say. I want to just mention that the future of financial services is becoming more and more digital. Using this new form of financial technology, starting from robot advising to decentralized infrastructure, is eliminating some of the inefficiency that we had in traditional financial systems, but it's also introducing new form of risk, right? We mentioned operational risk because of this interconnectivity between different computer programs, systemic risk coming from the fact that everything is so well interconnected and systemic, so if there is a problem in one area, it can propagate to others. Centralization, right? We have seen that governance, for example, is decentralized, but is it really decentralized? No, I showed you a graph where we see that the top 3 token holders in terms of governance tokens are already managing over 50% of the system. And in general, I think there is a lot of research to be done in terms of understanding better how we can manage the risk in these new forms of financial technology. And I will stop here. Happy to take any questions, and sorry that I think I didn't get any question along the way.
No, I think everybody is very much enjoying the talk.
Yeah, okay, that's good.
Yeah, thank you so much for the wonderful talk. And I think we learned a lot about this overview of the fintech, the new blockchain and risk roadmap in this new fintech area. And now I think for the interest of time, we still have time for 1 or 2 or 3 questions from the audience. If you have any question, please feel free to just unmute yourself and ask. I think Professor Agostino will still have several minutes here.
Yeah, absolutely.
Yeah, I can start. First question.
Yes.
So Professor Augusta, I saw you mentioned the art operations under DAOs. So in art operations, they might have a very long lead time. For example, if we have a DAO to decide what the exhibition, the art gallery gonna do, it might have a very long lead time. How do we guarantee, for example, when they propose the exhibition, the governance token might hold by a group people, maybe group A people, but when the exhibition maybe 6 months later or 1 year later, the governance token are held by another group of people. How do we kind of align the interest through the time? Or do you think this will actually make the revenue or the risk worse?
That's a great question, is it? Thanks for asking. For sure, right? This is an important question because, as you mentioned, especially for digital art, in general, yeah, for digital art or for other services, what happens that the time where you make the proposal is, as you mentioned, different from the time where the action happens.
Yeah.
And at the moment, there are like, at the moment, this is an issue in the sense that you can only vote at the time where the voting decision is in place. Usually, I mean, if we think about art and music, when we think about digital art or music, we have to think about the fact that we are digitalizing this piece of art. So it's no longer really taking a long time as when you are in an auction house, because now the transactions happening through these digital tokens is typically happening faster, right? The idea of digitalizing music or art is essentially to reduce the time that it takes to execute a transaction. So we want to have more transactions compared to instead waiting, as you mentioned, like some longer time outside of the chain. So bringing this art on chain also makes the transaction time and the execution faster. But nevertheless, I want to answer the question, okay, what happens if there is some lead lag time between the time where the proposal is issued and the time where voting happens? At the moment, I think it's only based, and at the moment basically depends on how many tokens, governance token you have at the time where the proposal is made, is what typically matters, right? In the sense that, okay, we have this proposal, those who hold this governance token will be able to hold this proposal, and we will vote for this proposal now, immediately, even if the implementation of this proposal will take place like sometime in the future. But if, I mean, an idea that I have, my idea is that if we want to take into account latency as well, and we want to discourage the fact that, okay, what matters is only how many governance tokens you hold at the moment of voting, I want to make sure that you are really seriously engaged with the project. So if you have held this governance token for some time, then I will give you the more voting power. So that's basically a way to take care of what you said. Now, it's not really the percentage of governance tokens that you have today, but also how many governance tokens did you hold like in the last month or so, right? I want to make sure that you have a serious interest into the project. It's not that you are just buying this governance token today because you want to influence the voting decision and then you will sell them tomorrow. So I think voting scheme could be based on, one could track like this holding of governance token, and then making sure that your voting stake will depend on your commitment to the project over the last few days. I don't think this is, I mean, this is one of I think this is one of the proposals that I think is feasible, because I can see your digital address, and then based on your digital address, I will see how many governance token you hold, and therefore I can enforce that. I don't think it has, I mean, it has been, I mean, I mentioned this in one of my survey papers, that this could be one way of addressing this problem of giving voting power to those who are really committed to the project.
Thank you.
Yeah.
Thanks for the question. I think it was a very interesting question.
Yeah, thank you for the question and for the great answer to the question, Agostino. Any other questions from the audience?
Oh, hi, Professor Agostino. First, great presentation. And I have another question also related to time. Basically, it's the relationship between the transparency of the blockchain and the cost of verification. That is like, for example, if in a scenario that time is not that important or transaction is not that fast, for example, in transaction on Ethereum, then I can take time to go to Etherscan that you mentioned in your slides and verify some transactions. However, like also as you mentioned, like there are some new technologies like Solana chain that can process like 50,000 transactions per second, so very fast. Then in a scenario that time is very important, and or 1 second there could be many transactions, then how do you think of the trade-off between like transparencies and the time need to verify it, like to incur to verify it? So there are situations that time is important, like I want to buy a newly launched token or new launched NFTs. The time is important. However, I also need to verify it since it's transparent, but it's kind of a trade-off. So how do you think of this situation?
Yeah, it's another great question. I agree with you that on the one hand, we want to reduce the time between consecutive blocks, because then we want to take advantage that if there is a profitable opportunity, we can take advantage now, and maybe if we wait 12 seconds from now, it's no longer being profitable. But then, of course, as you mentioned, there are like a lot of challenges, because if you made this transaction, the time between consecutive block too small, then, for example, if you take 0.4 seconds to finalize a block, that means that you need to make sure that you can verify potentially up to 59,000 transactions in the space of 0.4 seconds. So there might be errors, there might be maybe verifications which are not well done, and therefore there could be fake transactions which are included in the blocks, right? So I mean, that's why this trade-off is important, and that's why Solana, I mean, is still evolving, because of course we cannot do that. We cannot complete the verification so quickly. I think there will be, I mean, some techniques that are currently being explored to deal with this trade-off. I mean, this is a trade-off that cannot be, I mean, I don't think there is a win-win situation that you can process so many transactions incredibly fast. There have been some progress made in terms of transaction verification with some new protocols that have been designed, for example, zero-knowledge proofs and many other protocols which try to verify, for example, the integrity of a transaction without really looking too much into the content, or without verifying entirely the content. So these are these are more in computer science cryptographic advancements. There have also been some way of migrating some of these transactions to the so-called layer 2. So instead of hosting everything on the underlying infrastructure, which is called the layer 1, you create another layer which has typically maybe lower fees, where you can submit more transactions, and you can use you can use more sophisticated software algorithms to verify. And then once the transactions are being verified, you add them to the blocks, you resynchronize them with the blocks on the layer 1 chain. So there are some technologies that are being exploited precisely to increase the block time, and to reduce the block time and to increase the capacity of the blocks without compromising the integrity of the transactions.
Okay. Yeah, thank you. Thank you very much.
Thank you.
Thank you for the question and for the answer again. I think for the interest of the time, we can conclude here. And thank you again, Professor Agostino, for your time for the wonderful talk today. And thank you everyone for joining our second episode and for staying until the very end of the presentation. So have a great rest of the day. Thank you so much. Hope to see you in next month. Thank you, everyone.
Thank you, Yukan. Thanks for the opportunity, and thanks everybody. If you have other questions, feel free to reach out to me.
Thank you so much.